Alright, so here we are in our Excel position sizing spreadsheet. Now, the spreadsheet is available to you for download with this session, so make sure you download it and use it after you go through this session. So now let's talk about our position sizing model that we're going to use. As you'll see, the spreadsheet is labeled position sizing with percent risk model. So that's what we're going to look at here, the percent risk model. Now, just as a general note, there are many different position sizing models. Mathematicians and statisticians over the years have come up with various ways and methods to go about position sizing. Some are better than others. I personally think this is one of the very best ones, and it's the one we use in our own trading. Others will argue that there's one called the Kelly position sizing model, the optimal F. You'll hear these kind of terms. Well, that may very well be the case, but at this point in your trading career, right, when you're either just starting out or you're still struggling, you're a developing trader, you haven't reached consistent profitability yet, what you want to go with is a position sizing model that is the best at limiting risk while also being simple and easy to use. And in my opinion, this is the one that meets those requirements the best. It's very easy to understand, it's very easy to use, and that'll ensure that you use it with discipline. Now, what is the percent risk model? Well, it's actually pretty simple, and let's get right into it with this example, right? Once I show you the example, you'll be able to understand it pretty easily. So as you'll see, we have a hypothetical account size of $15,000. We're trading the ES, which is the obviously S&P futures. And we're assuming that we have a trade where we just entered at 1300 in the ES, and we have a 2-point stop. Now, for anyone that's completely new at this, when you buy, you enter on the long side and you've bought, you want to protect yourself in case you're wrong. You want to limit your risk. So what you do is you enter a sell order called a stop below your entry price. And if the market drops from where you bought it and hits this stop, it's automatically executed. A sell order goes out and you get out of your position. So this is like an emergency exit that you should always have in the market. So just as a side for any complete beginners here. The point value of $50 shows what the value of each point is in the ES, right? When you're trading the ES, the value of each point is $50. Now in this example, we're assuming that we have a 2% risk that we're using. This is discretionary, you can choose it, and in the next session we're going to get into how to choose it and what's the best risk level to have, but for now we're just assuming for simplicity's sake a 2% risk. So what is this showing? Well, here's what it's doing. It's saying, okay, we have a $15,000 account, and what we want to do under the percent risk model is any trade that we take, we want to risk a certain percentage of our account size on that trade. Alright? So in this instance, on any trade, we want to risk 2% of 15,000, which is $300. Any trade that we take, we'll risk $300 on it. So the question is, what position size is going to give us that $300 risk? And the formula here shows that a position size of 3 S&P contracts will give us a $300 risk on this trade, on this entry with this stop. Now, how do we come to that? Well, it's very simple. If our stop is 2 points, that means if we enter here and our stop gets hit and we exit, 2 points times $50 a point of the S&P is a $100 loss, right? It's a $100 loss per contract. But we want to risk $300, 2% of 15,000. So how many contracts do we have to use to risk that? Well, 3. If one contract will give us a loss of $100 and we want to risk 300, we'll have to use 3 contracts. So it's that simple. Now, how does changing different variables affect the position size? Right? So for now, the risk under the percent risk model is fixed. We're using a 2% risk. Right? But let's say we have a trade that doesn't have a 2-point stop, let's say we have a trade that has a 6-point stop. It's a much bigger setup, or volatility is high and we need a bigger stop, right? So what would our position size be? Well, let's actually input it and see. A 6-point stop would mean that the stop would be at 12.94, and as we see, our position size goes to 1. Why is that? Well, a 6-point stop at $50 a point is $300. But we want to risk is $300. So all we need is one contract to risk that $300. You see how it is? Well, now assume we want to use a 2% risk, but we have a much larger account size. Let's say we have a $150,000 account instead of $15,000. Well, what happens? The position size becomes 10 instead of 1. Because now 2% risk is $3,000, right? And at a $300 per contract stop loss, you'd need 10 contracts to get that risk. So it's very simple math, and this is how position sizing with the percent risk model works. But notice what the percent risk model is actually doing. What it's doing is it's fixing the dollar amount of risk per any given account size. Okay? So at $150,000 with 2% risk, you're going to be risking $3,000 a trade. Now it doesn't matter how big the stop loss is in that trade, right? Even if it's a 2-point stop loss, we take it back to 2 points now, 12.98, you see that the position size becomes 30, right? Why? Because a 2-point stop loss is only $100, and you need 30 contracts to get a $3,000 loss or $3,000 risk. So what we see is the position size keeps changing to keep the dollar amount constant that you're risking. Of course, as the account size changes, right? Let's say you make money, and this goes from 150, let's say, to 175. Position size also goes up. Why? Because now 2% of 175 is $3,500, not $3,000. So with a different account size, of course, the dollar risk becomes higher, and position size is accounted for accordingly. Now, what is the benefit of keeping dollar risk per any given account size fixed? What is the benefit of that? Well, there's actually several benefits. The first benefit is that we get to compare different trades on an apples to apples basis. We get to equalize all trades. All right? So let's say I have two different strategies, two different setups that I trade. And one setup uses 2-point stops and the other one uses 4-point stops. Well, if I didn't equalize the dollar amount risked between each trades, if instead I just say, let's say I just go, okay, I have a $20,000 account. Let's just take this back to 20,000 to be more applicable to most beginning traders. All right? So let's say I have a $20,000 account, and strategy 1 uses a 2-point stop, okay? And strategy 2 uses a 4-point stop. And this is just for simplicity's sake. What would happen if I didn't use the percent risk model, and instead I just used a fixed position size? Let's say I always used 4 contracts. Even as my account size went up and down, right, I used 4 contracts. Well, for a 2-point stop strategy, that means you have $100 of risk per contract. The loss when you have 4 contracts is $400. But with a 4-point strategy, your loss is going to be $800. So strategy 2 is going to give you twice as much loss as strategy 1, even though in essence they're just different setups. I.e., in essence, you don't want to be risking different amounts on them. They're just two different setups within the same account. So why are you losing twice as much on one setup as the other? Right? But if you use the percent risk model, the 2-point stop one would give you a position size of 4, while the 4-point stop one, 12.96, would give you a position size of 2. This would equalize the dollar risk, keeping the dollar risk at $400, and now we have equal risk across strategies. So this is the first thing that the percent risk model does. It allows you to compare apples to apples across strategies, across trades, and it doesn't allow certain trades that just happen to have bigger stop sizes based on the market, based on the market structure. It doesn't make them carry more weight, which they shouldn't be. It keeps them equal. But the second and more important benefit of using this percent risk model is that it keeps you from doing psychological errors and mistakes related to probability, like we saw in the example before, where you lost a whole $1,000 account based on faulty position sizing. If you had this position sizing model, right, and you were risking a fixed percent risk of your account, you would not have risked that much bigger amount on the fifth trade just because you had 4 losses in a row. You would have had this fixed position sizing model and you'd have to stick to it. It would be your guide to what you had to do. Regardless of whether you're losing or winning, that doesn't matter. This is rigid. See, what we want to do, we want to be dynamic, we want to be fluid in our market reading, in our entries and our exits based on how the market is acting. But when it comes to position sizing, we want to be rigid, we want to be straightforward, we want to be black and white. Once you're a consistently profitable trader and you know the markets inside out and you've had years of experience, then you can take position sizing and you can apply discretion to it. But in the beginning, as you're developing for the first couple of years, stick to a fixed percent model. Trust me on this one, it'll be the best thing you ever did for your trading. It's what made the difference for me in my trading. When I first started out trading, I started out with a less than $50,000 account. I was only trading 1 lot because I was learning. And I used this percent risk model. At that time, I think I was risking 1.5% per trade. And slowly and slowly and slowly, the amount of contracts started rising as I made money and my account grew bigger. I didn't change the 1.5% risk, I just kept it equal. And it grew and it grew and grew until a couple years later, I was trading 50 lots on the S&P. And sometimes when I'd be adding to winning positions, which we won't get to here, I'd have 100 lot positions on. And that all started with 1 lot, but grown systematically with discipline. And what it allowed me to do is stay in the game. I never risked too much. When I'd have a losing stretch, which I did numerous times, it never really affected me. Okay? Now we'll get back to that whole issue, but that's the benefit of just using a model and sticking to it, is that you don't fall in those psychological traps. You just stick to the model. Not only that, the next benefit is that it decreases the amount of decision making that you have to do, which is great because it frees up your mind to think about the market. So if you had to decide each time, how much should I trade this time, how many contracts or how many shares if you're trading stocks or all that, those are all decisions that take up valuable thinking real estate and slow you down when you just want to execute. But having this, you instantly know what position size you should use and you just go with that. And finally, the last benefit of using this model is that it's great for risk management while also being great for compounding profits. See, what happens as you're growing your account, right? Your position size is growing along with it. If you have a $20,000 account on a 4-point stop, you're going to use a position size of 2. But if you've grown your account to, let's say, 60,000, well, now that position size is 6 on a similar trade. And it'll keep going up, right? But if you're losing, instead of 20,000, let's say you went down and now your account's at 15,000, it takes it down 1.5. Well, you can't have a half a contract, so you would take it down to 1. Right? So this is what the professional gamblers do right and what the losing gamblers do wrong. See, what the losing gamblers do is that once they're losing money in their account or in their balance, what they'll do is that they'll bet higher. They'll bet larger to try to make it up. And if they're making money, they'll bet smaller because they're afraid of losing the profits. They want to protect them. Well, that's the exact opposite of what you should be doing. As your account loses money, you should bet smaller to protect your capital. And as your account grows, you should bet bigger to increase your capital? Well, the percent risk model does this for you automatically. Since percent risk is fixed, the dollar risk is going to go down as your account decreases and is going to go up as your account increases. So it automatically aligns you with correct principles of growing an account. All right. Now, what I've done to encourage you to using this, and I stress the importance of using this over and over and over, and I won't stop until you do use it. All right. What I've done is I've created a position sizing reference sheet for you that is also available in the spreadsheet for download and that you can use. So let's go to that. All right, so here's our position sizing reference sheet. Now what this is just a simple quick reference sheet for you with all the different contracts here. We have the ES, we have the NQ, the NASDAQ, the Russell, the Dow, gold. I think I have also oil in here. So these are just some of the major futures contracts that people trade. They're not all in there. You'll see the formulas. I'll explain them now, and you can just copy and paste and put your own instruments in there, anything you want. But let me just explain this real quick. So instead of always having to, let's say you're trading and you want to use the percent risk model, right? Instead of always having to, every trade you make, come into here and input this in and see how many contracts you should trade, what your position size should be, you can have a quick reference right here. So let's take a look at ES for an example right here, right? Okay, check out the formula right up here. Okay, as you'll see, there's a 20,000 account size, so I've loaded that in there. We're assuming that the account size is 20,000 here, and right in here is the risk. Here I've loaded up 1.5%, just for example's sake. So we have the account size times the risk, which gives you how much you want to risk per trade, divided by A12 here, which is 2 times 50. Now what is this 2? Well, these are the different stop losses you can have. See, the ES moves in quarter point increments, so I've just put as many of them as I can for you. So this shows you that if you have a 2-point stop loss, right, 2 points right here times 50 is $100 risk, and the account balance times the percent gives you how much you want to risk. So 20,000 times 1.5% is 300, divided by the $100 risk gives you what? 3 contracts. See, it's a very simple formula. Now what you want to do is take this spreadsheet and actually input your own account balance right here. Instead of the 20,000, put whatever account you have and input your own percent risk level. Now we'll get into the percent risk levels in the next session, but you'll input whatever one you feel comfortable with here. Right? And this will stay the same for the ES, and that's it. And then you'll get what your position size should be for this instrument. Now for the NQ, for instance, right, it's $20 a point, so I've changed it to 20 here. For the Russell, it's $100 a point. For the Dow, it's 5, and for the gold, it's 100. So each one's different. Now when you add your own instrument to this page, you just got to make sure that other than inputting your own account and percent, you just make sure you're using the right point value for the instrument. Now if you're trading stocks, it's simple. You don't need a separate one for each stock. You'll just have the point value is $1. That's it. You won't have, because it doesn't have a multiplier like 50 or 5 or whatever it is. It's just $1. All right. But using this, we'll just give you a very quick reference sheet. You'll be trading, you'll have it up on the screen beside you, this Excel sheet, or minimized. You pop it up. You say, oh, I have a 4-point stop in the NASDAQ. I trade the NQ. I have a 4-point stop. How many contracts should I trade based on a $20,000 account, 1.5 risk? You quickly look and you see, oh, it's 4. Next time you have a 2-point stop, oh, I should use 8. I trade gold. I have a 2-point stop. I should use 2. It's that quick. And this really frees up your time, lets you make lightning quick decisions, and keeps you, most importantly, within this disciplined mindset of using correct position sizing all the time. Now what you never do is increase the risk during the day. You never do that. And you generally never want to do that unless you've after a few months you've reached some sort of consistency and it seems like you can take slightly higher risk. But you don't want to do it if you're losing. Trust me, it's a loser's game. If you think you want to make up your losses faster by having higher risk, it's a loser's game. And the next thing you want to do is reset the account value at the beginning of each day. All right, so there's no need to do it after each trade. Now, technically speaking, right, this value is going to be changing after each trade. You either have a winner or a loser, and should be changing. But we don't do it intraday because we don't want to be focusing on the money intraday. We want to be focusing on the correct process. Having you come and change this during the day just because you made a trade that won or lost a few $100s is not optimal. We're just shooting for general percentages here, general, and we care about what the formula will do for you overall. We don't care about exact, little numbers. So don't change this during this day. Just forget about it. Set it there. Even if you have losses or wins, doesn't matter. Just keep using the beginning day's balance as your risk. The next day, though, look at your account balance, right? Put in the new account balance and then use those position sizes for that day. Now, most day to day, it's not really going to affect the positions because the move shouldn't be that big from day to day. But over time, it'll change. Like I said, I started with 1 lots and ended up 50, 60 lots and sometimes 100 lots based on just using this, compounding the account over and over. So that's what you want to do. You have this reference sheet now. Use it. Don't just watch this video, think this is cool, and not use it. Use it. Be disciplined with it. You can make a million mistakes with everything else. You can choose the wrong entries, read the market wrong, be wrong in your strategy. All those things you can do, but you will survive for quite a long time if you do this right. So I will keep hammering it in because I can't overstate its importance. It's the difference, for me, it was the difference that made me a profitable trader. I stuck to correct position sizing and it didn't even need discipline for me. I just had a position sizing model and for me it was set in stone. I can't change this. That's it. I set it there. It was set in stone. I can't change it. And that's how you have to approach it. And if you do, I guarantee you, your odds of success are going to go way up, better than most traders. Because most traders screw up on this part. They take positions that are way too big. They do it emotionally after a series of losses. They try to make it back quickly. They do all that kind of stuff. And in the next session, we're actually going to get into a concept called risk of ruin. Show you what the optimal percent risk should be. Show you what happens when you size your positions too large. And hopefully really instill the point of using this percent risk model to grow your account. So we'll talk about that in the next session.